Have you ever wondered why some people spend their entire lives struggling financially, like they're just stuck in this exhausting, endless cycle of bills? While others, they seem to steadily build wealth, brick by brick. Well, it's not just luck. It almost always boils down to understanding the actual mechanics of money. Welcome to This Explainer. Today, we're literally drawing out a complete chronological financial roadmap. We're going to break down these core wealth creation concepts step by step to fundamentally change how you view your money.
All right, let's dive right in. We've got 6 steps on our journey today. 1. Budgeting. 2. Savings. 3. Getting a handle on assets, liabilities, and debt. 4. The absolute magic of compounding. 5. Investing and risk management. And finally, step 6. Calculating your actual net worth.
Step 1. Budgeting, or managing your money. Because look, before we can ever hope to grow our cash into lasting wealth, we absolutely have to map out exactly what's coming in and what's going out. Now, your budget has to start with your true baseline, right? That is your adjusted gross income, or AGI. According to tax guidelines from the Vermont legislature, your gross income is the whole shebang, every single dollar flowing to you. We're talking wages, tips, commissions, rent you collect, even capital gains. But your AGI, that actually excludes specific items, like certain Social Security income or specific student loan cancellations. Nailing down this exact AGI number is literally step 1 for financial clarity. Okay, so you know what's coming in. Now we have to track what's leaking out. We split this into 2 super simple categories: fixed and variable expenses. Fixed expenses are your anchors: rent, your mortgage, the costs that are exactly the same every single month. Variable expenses, though, those fluctuate based on your daily habits: groceries, gas, utility bills. So the crucial point is this: when you identify your fixed and variable costs and subtract them from your income, you find your total financial surplus. And that surplus, that is the actual seed of your future wealth. So what do you actually do with that surplus? Well, the financial platform PocketSmith highlights a brilliant, highly practical method popularized by Scott Pape. It's called the barefoot bucket strategy. Basically, you physically compartmentalize your money into 3 distinct buckets. First up is the blow bucket. This is for your daily discretionary spending and short-term splurges. Next is the grow bucket. This is your wealth engine completely dedicated to long-term investing. And lastly, you have the mojo bucket. That's your rainy day safety money. Setting your accounts up visually and physically like this stops you from accidentally blowing tomorrow's wealth on today's cravings. And you know, that mojo bucket leads us perfectly right into step 2, savings and building a safety net. This is where we look at how to strategically protect the money we're building. To do this right, we need to look at data from Experian, which contrasts 2 wildly different but vital types of savings. First, the sinking fund. This is targeted money you set aside for a planned expense. Think an annual vacation or a car repair you know is coming. You are literally sinking money into an account for a specific goal. But an emergency fund? That is a pure safety net for unplanned disasters, a sudden job loss, a massive medical bill. Ideally, you want 3 to 6 months of living expenses sitting right there. Because without these 2 funds mapped out, even a tiny surprise expense can throw you straight into high-interest debt. All right, our day-to-day cash flow is sketched out. Our safety shield is up. Now we hit step 3, assets, liabilities, and debt. We are shifting gears to look at the big picture of your overall financial structure. If you want to build wealth, you absolutely have to master the difference between an asset and a liability. And the financial platform Ramp makes this elegantly simple. Assets are resources you own that hold or generate future economic value. Think real estate, stocks, or cash. Liabilities, those are financial obligations you owe to someone else, like loans or credit card balances. Honestly, the easiest way to think about it is this: assets put money in your pocket, while liabilities take money out. Now, what's really fascinating about this slide is the realization that, wait a minute, not all debt is inherently bad. Good debt is actually used to acquire productive, revenue-generating assets, like getting a mortgage on a rental property that pays you every single month. That improves your profitability. Bad debt creates obligations for things that just lose value, like putting a luxury vacation on a high-interest credit card. And you've got to watch the timeline on these too. Current liabilities are due within a year, while long-term liabilities stretch out way beyond that. Foundation set, debts managed. Now for the really fun part, step 4, the magic of compounding. This is the exact mechanism that transforms saved money into actual wealth. It's built on a concept called the time value of money, which basically means a dollar you have today is worth way more than a dollar tomorrow simply because of its potential to earn for you. To put that into perspective, the U.S. Securities and Exchange Commission uses this fantastic illustration of the exponential growth curve. Imagine you buy a simple slice of pizza every single day for $2. If you decide to skip that daily slice, you save $730 in year 1. Now, if you take that $730 just once and invest it at a modest 5% interest rate, by year 5, it grows to over $931. And if you just leave it alone for 30 years, that original $730 snowballs into $3,155.02. That is compound interest. You earn interest on your original money, and then you earn interest on that interest. And this brilliantly illustrates one of the most powerful, coolest mental shortcuts in all of finance, the number 72. As outlined by Saxo Bank, the Rule of 72 is essentially a cheat code to estimate exactly how long it takes your money to double. You just take the number 72 and divide it by your expected annual rate of return. So if you're expecting an 8% return, 72 divided by 8 is 9. Bam! Your wealth doubles roughly every 9 years. But, and this is absolutely crucial, you also have to use this rule to understand inflation. If inflation is running at 4%, 72 divided by 4 is 18. That means your money's purchasing power will literally be sliced in half in 18 years. It's a negative compounding force, and it is exactly why we must invest. Which brings us right to step 5, investing and risk management. To beat that inflation and actually chase those 8% returns, we have to transition from just saving money to actively investing it while managing the risks involved. Research from Bankrate breaks down the 3 big investment vehicles beautifully. Stocks give you actual ownership in a company. They can be pretty volatile day to day, but offer high long-term growth. Bonds, on the other hand, are essentially you loaning money to a company or a government. They're way less volatile and pay you steady interest. And mutual funds, that's where you pool your money with other folks to buy a whole bunch of different assets relatively cheaply. It's a total game changer because instead of betting everything on one single company's stock, mutual funds let you spread that risk out. And spreading that risk is literally the whole point of modern portfolio theory developed by Nobel laureate Harry Markowitz back in 1952. As Binance explains it, the goal is to mix uncorrelated asset classes, meaning if your stocks take a nosedive, another asset like your bonds or real estate might be doing great, which cushions the blow. You can do this passively through a strategic allocation, setting it and forgetting it, or you can use a tactical allocation, activity reacting to the market. By mixing traditional and alternative assets, you aren't eliminating risk completely, but you are mathematically managing it to protect your growing wealth. All right, let's move to our final destination on this map and see how all of this builds together. Step 6, calculating your net worth. It all comes down to the fundamental accounting identity, a bedrock concept from our MPS and Wikipedia sources. Assets equals liabilities plus equity. To find your own net worth, you just flip that equation around. Take your total assets, everything of value you own, and subtract your total liabilities, everything you owe. Whatever is left over, that is your equity. That's your actual net worth. It is the definitive scoreboard of the wealth you've successfully kept and grown. So there it is. We've drawn out the entire map today, from the daily mechanics of budgeting and buckets to emergency shields, right up the ladder through compounding and diversified investing. But look, a map doesn't do you any good if you don't actually take the trip. The earlier you learn and implement these fundamental concepts, the more incredible your financial future is going to be. So the question now is, what is the very first step you're going to take today to rewrite your financial